Stock. A stock is more than just a ticker symbol you check nervously on your phone every morning. It's a slice of ownership in a company. When you own a stock, you own a portion of that business, no matter how small. If the company does well, your share of the pie gets more valuable. If the company struggles, well, your slice can start looking more like a breadcrumb. But at its core, a stock is your ticket into the company's profits, assets, and sometimes even decision-making. Think of stocks like pizza slices. The whole company is the pizza, and each slice is a share. If a company issues 1 million slices and you buy 10,000 of them, you own 1% of that pizza. You can tell your friends you own 1% of a major corporation, which sounds impressive, even if that corporation is, say, a startup selling artisanal pencils. Stocks are also called equity, which is just a fancy way of saying ownership. That ownership can give you certain rights, like voting on big company decisions. So yes, technically, if you hold stock, you can influence the company's future. But if you own one share of Apple, don't expect Tim Cook to call you up for advice. Share. A share is the smallest unit of ownership in a company. You can think of it as the building block of a stock, the individual Lego brick that makes up the whole model. If you own one share, you own a tiny portion of that company. How tiny? Well, for big companies, it's like owning 1 grain of sand on a beach. But even that grain is yours, and no one can take it from you without your say. Shares can be bought, sold, or held indefinitely. If the company pays dividends, you get a slice of those profits proportional to the number of shares you own. If it doesn't, you're relying on the share's price to go up so you can sell it for more than you paid. That's the basic principle. Buy low, sell high. Although some investors accidentally reverse it and buy high, sell low, which is called panic selling. In polite company. Shares are also how companies raise money. When a business needs capital to expand, it can sell more shares to the public. This dilutes the ownership percentage of existing shareholders, but it also puts more cash into the company's hands. So in a way, shares are both ownership and currency, the financial version of those carnival tickets you trade in for prizes. Shareholder. A shareholder is any individual, company, or institution that owns at least one share of a company's stock. That makes them a part owner, entitled to certain benefits like dividends and voting rights. In theory, being a shareholder puts you in the same league as Wall Street giants. You and Warren Buffett are both technically shareholders, even if your portfolio is more 3 shares of Tesla than multi-billion-dollar empire. Shareholders can be active or passive. Active shareholders are involved in the company's governance, voting in annual meetings, influencing corporate policies, and sometimes agitating for change. Passive shareholders, on the other hand, may never interact with the company at all, beyond cashing dividend checks or checking their brokerage account once in a while. Your influence as a shareholder depends on how much of the company you own. If you hold a majority stake, you can essentially call the shots. If you own a few shares, you still get a say. Just don't expect your vote to outweigh that of a pension fund with 10 million shares. It's like owning one voice in a choir. You're part of the harmony, but you're not conducting. Stock exchange. A stock exchange is a marketplace where buyers and sellers come together to trade stocks, bonds, and other securities. Think of it as the Wall Street version of a farmer's market. Except instead of buying organic tomatoes, you're buying pieces of corporations. Exchanges provide a regulated environment where prices are transparent, transactions are standardized, and investors have a fair shot at making deals. Major stock exchanges include the New York Stock Exchange, NYSE, and the Nasdaq. Each has its own rules, listing requirements and personality. The NYSE is like the traditional suit and tie banker, steeped in history and ceremony. The Nasdaq is more like the hoodie-wearing tech entrepreneur, fast-paced and tech-driven. Both serve the same purpose: to connect people who want to buy with people who want to sell. Without stock exchanges, buying and selling shares would be chaotic, like trying to trade baseball cards in the dark with thousands of people shouting different offers. Exchanges bring order to that chaos, matching buyers and sellers at agreed prices. They also act as gatekeepers, ensuring companies meet certain standards before they can list their shares. So investors aren't buying into something as shady as Bob's Discount Bank and Petting Zoo Incorporated. Public company. A public company is a business whose ownership is divided into shares that can be bought and sold openly on a stock exchange. This means anyone, from a pension fund to your next-door neighbor, can own a piece of it. Public companies are subject to strict regulatory rules, including filing quarterly and annual financial reports, so that investors have the information needed to make informed decisions. In the United States, these rules are set by the Securities and Exchange Commission, SEC. When a private company goes public, it opens the door to large-scale investment from the general public, often raising millions or even billions of dollars in the process. For example, if a company issues 100 million shares at $25 each during its IPO, it raises $2.5 billion in new capital. In return, it must answer to a wide range of shareholders, from small retail investors to massive institutional funds. The catch? Being public also means living life under a financial microscope. Every earnings miss, every unexpected expense, and every executive slip-up becomes a headline that can send the stock price swinging. It's like being in a reality show where millions of people watch your every quarterly move, except instead of voting you off the island, they sell your stock. Bull market. A bull market is when stock prices are rising over a sustained period, usually driven by strong economic conditions, investor optimism, and plenty of buying enthusiasm. The name comes from the way a bull attacks, thrusting its horns upward, which is fitting because that's exactly the direction investors want prices to go. In a bull market, optimism feeds on itself. Higher prices attract more buyers. More buyers push prices even higher. And suddenly, everyone's convinced this party will never end. Portfolios look healthier. Coffee tastes better, and even your skeptical uncle starts asking about getting into the market. But while bull markets can feel unstoppable, they're not invincible. Economic shifts, changes in interest rates, or unexpected events can bring the run to a halt. Smart investors enjoy the ride, but don't forget that markets, like bulls, can be unpredictable, and those horns can swing both ways. Bear market. A bear market is the opposite of a bull market. Prices fall by 20% or more from recent highs, and pessimism dominates. The term comes from the way a bear swipes its claws downward, which perfectly captures the market's mood during these times. In a bear market, optimism dries up. News headlines turn gloomy. Investors rush for the exits. And the friend who bragged about doubling their portfolio last year suddenly avoids talking about stocks. Selling pressure can snowball, pushing prices down further and making it feel like there's no bottom in sight. While bear markets can be unnerving, they're also a natural part of market cycles. Long-term investors often see them as clearance sales for quality assets, while short sellers see them as hunting season. The key is to stay calm. Panicking in a bear market is like running from a real bear. It usually doesn't end well. Volatility. Volatility measures how quickly and by how much a stock or market index moves up and down. High volatility means big price swings in short periods, while low volatility indicates more stable prices. It's often measured by statistical tools like standard deviation or market indexes, such as the VIX, which is nicknamed the fear gauge. For example, if a stock moves from $50 to $55 one day, then drops to $48 the next, it's highly volatile. On the other hand, a stock that trades between $49.50 and $50.50 over the same period has low volatility. Traders thrive on volatility because it creates opportunities for quick profits, but it also increases the risk of quick losses. Think of volatility like the mood swings of the market. Some days it's calm and reasonable, and other days it's throwing furniture across the room. It's exciting if you're prepared and terrifying if you're not. Investors manage volatility by diversifying portfolios, setting stop-loss orders, and avoiding knee-jerk reactions to sudden price changes. Volatility is often measured by indicators like the VIX, nicknamed the Fear Index. High VIX means the market is nervous and jumpy. Low VIX means it's calm and steady. But remember, low volatility isn't always good, and high volatility isn't always bad. It just means the market's mood swings are bigger or smaller, like whether it's having a mild disagreement or throwing a full-blown tantrum. Volume. Volume refers to the total number of shares traded in a particular stock during a set period, typically a trading day. If 10 million shares of Apple change hands in a single day, its trading volume for that day is 10 million. High volume can indicate strong interest or big news, while low volume can suggest a lack of investor attention, or that everyone's too busy watching cat videos instead of trading. Volume is a key indicator for traders because it adds context to price movements. For example, if a stock price jumps 5% on high volume, it suggests genuine market conviction. If it moves the same amount on low volume, it could just be a temporary blip caused by a handful of trades. This is why analysts often say, volume confirms the trend. For short-term traders, volume is like the heartbeat of the market, fast and strong when there's excitement, slow and weak when things are quiet. Long-term investors watch volume less closely, but still use it to spot major turning points, like when a stock finally breaks out of a long slump. After-hours trading. After-hours trading is exactly what it sounds like, buying and selling stocks outside of the regular market hours, 9:30 a.m. to 4 p.m., ET in the US. It usually runs from 4 p.m. to 8 p.m., with pre-market trading happening before the opening bell. It's like the market's after-party. Fewer people, different vibe, and sometimes things get a little wild. Because fewer traders are active after hours, liquidity is lower, meaning bid-ask spreads can widen and prices can swing more dramatically. A $2 move in after-hours trading might shrink to 50 cents when the regular session opens, or explode into a $5 move if the news is big enough. After-hours trading is especially important during earnings season, when companies drop their financial results after the market closes. It's where fortunes can be made or destroyed before breakfast. Just remember, the smaller crowd can make this exclusive club riskier than it looks. Circuit breaker. A circuit breaker is a safety mechanism built into stock exchanges to temporarily halt trading when prices drop too sharply, too quickly. In the US, the SEC has set 3 levels of market-wide circuit breakers. A 7% drop in the S&P 500 halts, trading for 15 minutes, level 1. A 13% drop triggers another 15-minute halt, level 2, and a 20% drop stops trading for the rest of the day, level 3. The idea is to give investors a breather, time to assess news and cool off, instead of panic selling in a frenzy. These were famously triggered during the COVID-19 market crash in March 2020, when wild price swings had investors feeling like they were on a roller coaster with no seatbelt. In essence, circuit breakers are the market's version of pulling the emergency brake on a speeding train. It doesn't fix the problem, but it can prevent a total derailment while everyone regains their composure and possibly their sanity. Market maker. A market maker is a firm or individual who ensures there's always a buyer and seller for a particular stock by continuously posting bid and ask prices. They profit from the bid-ask spread, the small difference between the price they're willing to buy at and the price they're willing to sell at. For example, if the bid is $50 and the ask is $50.10, a market maker might buy at $50 and immediately sell at $50.10, pocketing the 10 cents difference per share. Multiply that by thousands or millions of shares traded daily, and it adds up. Without market makers, trading would be far less smooth. Prices would jump more erratically, and investors might find themselves stuck without someone to take the other side of their trade. In short, they're like the market's matchmakers, quietly working behind the scenes to make sure buyers and sellers find each other without too much drama. Float. Float is the number of a company's shares that are available for public trading. It excludes restricted shares held by insiders, executives, or big institutional investors who aren't likely to sell in the open market. Think of it as the portion of the company's stock that's swimming freely in the market pool, as opposed to locked away in a vault. A low float means there are fewer shares available to trade, which can lead to big price swings if demand spikes, like when there are only 20 cupcakes at a party and 50 guests are fighting for them. A high float means more stability, since there's plenty of supply to go around. Traders often love low-float stocks because they can rocket quickly on even modest demand. But beware, that same low supply can cause the price to plummet just as fast, turning that rocket into a nosedive. Volume Weighted Average Price, VWAP. VWAP is the average price a security has traded at during the day, weighted by the total trading volume. Unlike a simple average, VWAP gives more influence to prices where larger amounts of shares were traded. This helps traders see the true average price based on actual buying and selling activity. For example, if 100 shares trade at $10, then 1,000 shares trade at $11. VWAP will lean toward $11 because most of the trading happened there. In this case, VWAP would be about $10.91, not the midpoint of $10.50. Traders often compare the current price to VWAP to judge whether they are getting an above average or below average for the day. Large institutional investors use VWAP to measure how well they executed their trades without moving the market too much. Capital. Capital is like the fuel in your financial engine. Without it, you're not going anywhere. In finance, capital generally refers to assets that can generate value for their owner. Most people think capital just means cash, but it can also be things like machinery, patents, or even a trademark so famous it sells itself. If you run a bakery, your capital could be the ovens, the delivery van, and the secret cupcake recipe you guard like it's the nuclear codes. Investors love businesses with strong capital because it means they can produce more goods, more services, and, let's be honest, more profit. Think of it this way. Jeff Bezos started Amazon with some seed capital and a garage. If he'd started with no capital, well, he'd probably still be in the garage, but selling lawn chairs on Facebook Marketplace. Liquidity. Liquidity describes how easily an asset can be bought or sold without significantly affecting its price. A highly liquid stock, like Apple or Microsoft, trades millions of shares daily, meaning you can buy or sell large amounts almost instantly without moving the price much. In contrast, imagine a tiny company with only 5,000 shares traded daily. Trying to buy 2,000 shares at once could push the price up sharply, and selling them could drag it down just as fast. That's low liquidity. A quick number check. If a stock's bid is $10 and its ask is $10.01, that 1 cent gap reflects high liquidity. If the bid is $10 and the ask is $10.50, the 50-cent gap shows low liquidity, making trades less efficient. Think of liquidity like an exit door in a crowded room. If it's wide and clear, everyone can leave calmly. If it's narrow and jammed, things get chaotic, especially when everyone decides to rush out at the same time. Bubble. A bubble happens when an asset's price rises far above its true value, usually because of hype, speculation, and the belief that, this time, it's different. At first, prices climb steadily, attracting attention. Then greed kicks in, driving them up at a pace that defies logic. From tulip mania in the 1600s to the dot-com craze of the late 90s, bubbles follow a familiar pattern. Early investors make big gains, word spreads, and everyone piles in, not wanting to miss out. Eventually, reality catches up. The bubble bursts, prices collapse, and the latecomers are left wondering why they bought a tulip bulb for the price of a small house. In finance, spotting a bubble in real time is tricky. It often feels like the party will keep going forever. The lesson: if you're buying only because it's going up, you might just be inflating your own role in the next cautionary tale. IPO, Initial Public Offering. An IPO is when a private company decides it's time to step into the big leagues and sell shares to the public for the first time. It's a bit like a band going from playing in their friend's basement to headlining at Madison Square Garden, only with fewer guitar solos and more lawyers. Companies use IPOs to raise serious cash, which can fund expansion, repay debt, or buy something important, like a giant headquarters with an even bigger ego. Investors line up for IPOs hoping to get in early on the next big thing, but it can be risky. Sometimes you're getting Amazon. Sometimes you're getting a company that tanks faster than a reality TV star's career. The IPO day itself is often a spectacle. Executives ring the stock exchange bell, pose for photos, and try not to look nervous while the market decides if they're worth billions or barely worth lunch money. Dividends. Dividends are payments made by a company to its shareholders, typically from its profits, as a way of sharing earnings. They can be issued as cash, like 50 cents per share, or as additional stock. Companies that consistently pay dividends, such as Johnson & Johnson or Procter & Gamble, often appeal to investors seeking steady income. For example, if you own 1,000 shares of a company paying an annual dividend of $1 per share, you'll receive $1,000 in dividend income for that year, regardless of whether the stock price rises or falls. Dividend yields, annual dividend divided by share price, help investors compare income potential across different stocks. You can think of dividends as rent payments for lending your capital to a company. They keep your investment working for you even if the stock price doesn't move much. Blue chip stocks. Blue chip stocks are shares of large financially solid companies with a track record of reliable performance. Think Apple, Microsoft, Johnson & Johnson, businesses that have been around long enough to survive recessions, market crashes, and questionable fashion trends. For instance, a blue chip company might have a $300 billion market capitalization, stable annual earnings growth of 5 to 10%, and a steady dividend payout. While they may not double in price overnight, they offer stability that high-risk stocks can't match. Owning blue chips is like having LeBron James on your basketball team. You're not guaranteed a championship, but you're sleeping a lot better than if your star player was some guy who once did great in high school. That covers the bedrock terms every investor needs to understand before they can talk about the market with a straight face. In the next video, we'll move into the boardroom and unpack the corporate actions, like stock splits, reverse splits, rights issues, and buybacks that companies use to reshape their shares and, sometimes, investor expectations.